All right, so welcome into the live stream today. We're going to be, of course, breaking down the FOMC meeting. As we know, we just got our news on the basis points hike, what is going to be expected from that. We'll drill down into all of that. Dive in also to the analysis of what Jerome Powell is going to be talking about in terms of the outlook. We'll also go, obviously, into the press conference and get some insight there, because usually that's where you're going to read between the lines. Let's dive in deep. My name is Paul Barron. Welcome back into Tech Path. As you guys know, here on the show, first thing I ask you guys to, when you like these kinds of live streams where we do some narrative as a live stream is happening, in this particular case, the FOMC meeting, hit the like button. If these are the kind of content pieces you like, if you like more analysis, this is what we're going to kind of drill into, all of that good stuff for you guys. Don't forget, of course, if you are not subscribed to the channel, make sure and get in there. It's first of all, it's very easy. It's going to give you guys a chance to join into our Diamond Circle, which is probably one of the best things that you can do around getting into our channel, because we do a couple of emails a week and we drop all that out to you guys free of charge. It's also where I do put in a few of our own findings, because we do a thing called our mastermind group, which is a real tight connected group. If you want to learn about that, just go to our website, you'll check all that. But it is where I'll do a few drop-ins in terms of videos, and we do AMAs, all those kind of things, so you can catch in on all those things. I want to jump over quickly just to this tweet here. The Fed hike, it did hit the 75 basis points, so that is still a very large percentage. I think a lot of people, everybody had baked in 75. Some traders were thinking that we might see a little bit softer position, especially as we're seeing DC kind of come out in droves trying to defend, and I'll kind of break all that down for you. Of course, here's the story right here. Fed interest rate hikes by 75 percentage point. This is for the second consecutive time in a row, so this is a pretty significant thing. Now remember, with Chair Powell, the goal is to get 200 basis points more by the end of the year to be able to offset what's happening with the inflationary scenario. So what we're dealing with right now is 125 basis points. If the Fed holds true on their promise of reducing or increasing interest another 200 points prior to this meeting, then we are still setting at 125 basis points yet to happen. Remember, we do not have a Fed meeting next month, so the next time we'll hear from the Fed is going to be in September. There's one scenario thing that I think is playing into this that is a little concerning, I think, from a political standpoint, from the Dems standpoint, and that is that they may have went out too early with this. Now, hear me out on this, because this is still my thesis on what will happen toward Q3 and Q4 of potentially the scenario where we start to see the market somewhat recovering. Two things have to happen. One, we have to get Powell, the Fed, to be able to pull the foot off the neck and release a little bit of market pressure that has been building up, obviously, for over the last 6 months. That's the first thing that has to happen. CPI numbers, meaning the consumer price index, has to start slowing, and we do have to see a reduction in terms of inflation. And if that starts to occur over the summer months, which are some of the highest price months of the year in terms of cost and things of that nature, fuel costs, etc., we still have some challenges ahead of us. So the key will be is, if they've gone out fairly light on this will be my question, is I still believe we're going to see a hawkish response from Powell in terms of the press conference, which to me is still the scenario that pushes a lot of pressure onto Bitcoin. Now, will we see a little bit of a jump in Bitcoin? It's very possible we will. We'll jump to the charts and break down all of that good stuff today. I want to jump over to a Fox video here that was kind of talking about Yellen and really DC in general, because I think this is a position that DC is starting to frame up to kind of reposition how a recession may be looked at. Let's jump to that clip.
Own definition of a recession, vaguely saying we are in a recession when there is, quote, a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Here to talk about it is Kevin Hassett, former Council of Economic Advisors chair and author of The Drift. Kevin, good to see you. Give me your take that the White
Great to be
House thinks that they can just rewrite the definition of a recession and we're all supposed to take that?
You know, they're trying to get out ahead of bad news, and they're doing so in a way that I don't really think is honorable. The fact is
So, okay,
that,
so pretty straightforward
you and
on what they're
everybody
trying
else
to do
know
here.
as
I think the
journalists
scenario that you deal
and
with
elected
on
officials
what they're
that
going with
two
is two
negative quarters-
things. One, of course, is the situation where the White House is trying to get into a position that is kind of front-running a recession. So obviously the GDP is up to the point to where we do have 2 consecutive quarters. That, of course, is the scenario that is the classical description of a recession. How the White House responds to this, I think, will dictate to markets if the White House is trying to soften this and kind of move into this much more soft approach, which I think will be kind of the narrative of Chair Powell today when we jump into what he's going to be talking about in the press conference. This is going to be a very critical time. So analyzing not only the response of DC into what's happening, and when you think about the response of DC, I want you to think about Janet Yellen. You also obviously are going to look to Chair Powell. And in addition, there are going to be certain Democratic representatives and congressmen that would position this as a softening of the market, meaning that we've maybe got a retracement in terms of our economy and what it might look like going into the midterms. Because all of this, I still believe, is a narrative that is flying into the midterms. So again, remember, do not forget that Yellen really was the one that is playing this down, because she, of course, remember, was the one that said, hey, this is transitionary. It is one of those things that we're just going to see it for a very short time. And obviously their position, I think, with Janet Yellen, remember, she also called for a press conference post this FOMC meeting. To me, that is usually an indicator that starts to sell into an idea of what is damage control. Damage control, I think, is one of those scenarios that you kind of just have to deal with what's happened within the market. People are going to kind of know the facts, and then you're going to try to repaint the narrative to give a little bit of calm and cool nature from the investment side of things. So I think we'll see a lot more coming out of DC over the next week that will start to temper or try to temper what's really happening. The market, though, I think will be very questionable in terms of how they respond to this. And again, I think all of this really leans in on and hinges on what Chair Powell is going to talk about today in the press conference. Now, a lot of people look at, well, all right, so this is good. I mean, not good in the sense that we've seen now 1.5 points in the last 2 months of interest rate raises. This is going to continue to put pressure on the housing market. We're going to see pressure on the used car market. We will continue to see pressure, I believe, on the energy markets. And more importantly, I think we'll start to see the slowing and the pressure on the jobs market. And I'll show you some of that here in a second. But one of the other things that is kind of playing into this is the EU. Now, again, we look at the European Union and just how many countries are involved in the ECB. And you have the European Central Bank, of course, surprising markets with a larger than expected rate hike. It's first in 11 years. So this was a big deal in Europe. And it is a big deal because when you look at the G20 countries and the global economy as a whole, because now, it used to be, I think, 25 years ago, the United States was kind of on its own in terms of economic powerhouse. There was, most of it was self-bred in terms of supply chain, all those kind of things. We've evolved beyond that to a greater extent over the last 2.5 decades that has pushed us into a very interesting global economic front, which is why what's happening in Europe is so critical. Obviously, we know that from the sense of crypto because we are seeing crypto on a much more global scale. So all these kind of things from macro side of things do matter. And obviously, what's happening in Europe matters. The ECB is a very important role in the overall recovery of Europe, which will have a huge factor on how we start to see a potential recovery from a recession here in the United States. Now, some of the other signs that you have recessions in play is when some of your best and brightest companies start to miss their mark. And of course, here you have Microsoft, of course, missing estimates, but their stock was up just slightly. But remember, their miss was just by a little bit. Alphabet actually missed by almost 10%, that being Google. So when you look at the stock exchange and just some of the major innovative companies that are out there right now that are having their first real challenge, remember, we still have a lot more earnings coming in this week that will continue to paint this narrative, I think, of a slowing economy. Now, this is good news and bad news. Good news in the sense that the Fed may pull off the brakes. That is, in my opinion, a good news kind of scenario because it does mean that the bottom might be in. The bad news is that what happens when you hit kind of a crash landing on these bottoms like this, in some cases, it's hard to stop the momentum that is starting to move in place. In other words, Microsoft could see another worst quarter. Meta will see a bad quarter. Obviously, Amazon, Alphabet, etc., will continue to see this. And remember that job numbers always are a trailing indicator, as well as the other big kind of 800-pound gorilla in the corner, and that is housing, which is going to be the real estate market. So all of this, I think, really kind of pins into two things happening, and that is on how Wall Street looks at this over the next little bit. So again, Wall Street rising on Microsoft, Alphabet earnings as Fed decisions looming. Now they know we have the 75 basis points in, and the scenario that's going to kind of play into this overall is going to be questionable, as I said, for how not only Powell softens it up. The question will be, is it hawkish or is it dovish? Does he give us a little bit of a runway that starts to put us in the direction of maybe a recovery and maybe a bottom for the crypto markets and the stock exchange itself? So lots happening. Make sure and get your questions in over on the side. Bitcoin seems to be moving just slightly here, just now clipping over 22. I think we're on the minute. Are we still on the minute there? Yeah, so a little bit over 22, up from about 20,006 today. So some movement here on the news of the 0.75. Again, I think a lot of that was baked in to what's happening within the markets right now. But as I said, don't forget, hit the like button. We'd love to get your feedback on these kind of pieces. And also, when you guys have questions, because we try to answer as many questions as you can, drop them in on the side chart. We'll try to get rolling on these for sure. All right, so let's take a look here also at inflation, because this is something that was kind of interesting to me. And this was this article by Grid, Great Slowdown, Why Inflation, Housing, and the Labor Market Might Be Showing a Recession or Something Else. And this is kind of the scenario that people are looking at. Is this some other kind of economic slowdown that we have not identified in historic elements? And this is, I think, what Yellen is trying to get to. It's also, I think, what Powell will try to get to today, around that we even though we have seen GDP, 2 quarters of reduction in GDP, the actual scenario is this whole jobs scenario where we are still seeing jobs holding on, but at the same time still declining in certain sectors. And the sector that I watch more than any is retail, and retail meaning mostly restaurant and retail. Those are the jobs that are really feet on the ground jobs, and they're the ones that I think matter the most in the essence of whether or not we see this recovery start to roll out. So again, jobs will be a very critical part of this. It also gets into a narrative that I talk about a lot, and that is how this kind of recession could have an effect on the credit crunch. And what I mean by that, remember, stimulus runs out, has been running out. The next layer in is that we get pressure on pricing, which is what we've had over the past several months. And eventually those types of savings and or income start to exhaust. And then the next layer to move into that, and we've already shown this with rising credit positions, is a credit crunch. And what I mean by that is that people will revert, because remember, they'll revert to using credit. They will not slow down their spending habits. And in most cases, if you have the White House and all your politicians kind of talking to you that this isn't a recession, don't worry about it, everything's fine. In essence, I mean, it's a little bit irresponsible because it doesn't really give people a full view of what's happening economically. And I think that's the concern that is a little bit more, confusing. They even say it here. This is one of the most confusing times in recent memory for the economy. If you listen to what people say, there's an unprecedented gloom. Meanwhile, employers are hiring at a pace that only modestly compared to massive job gains in the past year. Again, I think this is a scenario, because we've already seen it here in the crypto space where we've seen a lot more job layoffs and we've seen job acquisitions outside of Binance, who claims that they're looking at ways to go in and hire more people. And I do think this is one of those kinds of scenarios, and I talk about this all the time, is that you can get into a position where you can really start to really gain some strength in your position around what's happening in the market. I know the Fed is getting ready to go live here in a second, so I want to jump over to that. And it looks like they're getting ready to go live. So let me just unmute that. We'll jump to the meeting real quick. Let me go to full screen for you guys. Let's listen to what the chairman has to say.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC
That's
raised its
interesting that
policy
they
interest rate by 3/4 of a
accepted
percentage
that the labor
point,
market is tightening
and anticipates
still.
that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
All right, this should be interesting because
Recent indicators of
tightening is a
spending
big
and
deal.
production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter.
would agree with that.
Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
Yeah, he seems like he is really
Labor demand is very strong,
tiptoeing
while
around
labor
this
supply
too.
remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 3/4 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet,
I
which
think
plays an
people
important
feel that
role
this isn't
in firming
a
the stance of monetary policy.
positive look just yet with what Chair
Over coming
Powell is
months,
saying.
we will be looking for compelling evidence that inflation is moving down, consistent with
Yeah, that's a
inflation
key
returning
word.
to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then.
My guess is he's not
We will
going
continue
to
to make our
accept
decisions
that
meeting
we're in
by
a recession.
meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Rally.
Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves
Yeah, I think you're right.
in unexpected ways.
Jay, is that damage
Inflation
control right
has
now is
obviously
very,
surprised
very
to the
critical.
upside over the past year.
Both
and
from
further
DC and
surprises
also
could be
with
in
what
store.
Chair Powell is saying here.
We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time.
He did mention
We are
earlier
highly
that it
attentive
was
to inflation
compelling
risks
evidence is what he's
and
looking
determined
for,
to take the
which
measures
me
necessary
says
to
a
return
lot
inflation
around that
to
they're
our
not
2%
planning to
longer-run
slow.
goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Yeah, not a lot of answers.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This will be interesting to see the questions. Geez, everybody had one.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any
Yeah.
discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases.
So we are
in the
watching
policy
to
rate that
answer
we've been
your.
making. I'd say that we wouldn't
Gdp.
hesitate to make an even
We're
larger
watching
move than we did
sentiment right
today
now
if the
today
committee
very
were to
closely
conclude
because sentiment will
that
be
were
a
appropriate.
big factor. We wanted
was
to
not the
post our
case at this
sentiment
meeting.
data
Very broad
on the
support,
CPI
for the
after
move that we made.
the Fed meeting, so we'll be able
mentioned
to
the
kind of
June meeting.
gauge a
We
little bit where
had said many
Bitcoin and
times,
crypto in
that
general
we
is
were
going.
prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
This concerns me a bit in the sense that we might see a 75 come in, maybe even on the next
Thank you so much for
report.
taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the
Still
question
look
is,
fairly
how are we
confident,
thinking
though.
about
I mean,
the
just
path
in his
forward?
stance of
So
where this may be
one thing that
going
hasn't
forward.
changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target.
Yeah.
And it's also worth noting that these rate hikes have been large and they've come quickly,
fast.
And it's likely that their full effect has not been felt by the economy. So there's probably
and I think
some
that's the
additional
question
tightening,
he's hitting on right
significant
there.
additional
Is
tightening
is
in
gonna
the
be
pipeline.
a big deal.
So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks.
So not necessarily an update on that.
So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now.
A
It's
couple
one that
other
we'll make
tokens
based on
on
the
the
data we
move right
see.
now. Obviously,
And
there
we're going to
would
be
be a
making
swap.
decisions meeting by meeting. We think it's
And again, remember, the
we
way
think
they
it's
collect their
time
data is very unique.
to
The
just go
Fed
to a
does
meeting
a
by
lot
meeting
of surveys
basis and
to
not provide,
collect kind of the
clear
temperature of the
guidance
market.
that we had
That's their
provided
data
along the way.
and their mechanism for being able to really get these readings, especially around the CPI.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need
Ethereum coming
to
in
keep
with a
financial
slight
conditions
move.
tight?
Again, these are,
in
I think
order
this
to
is more
moderate
of a
purchasing power and
sideways
bring
position.
inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times, what the economy is going to be doing in 6 or 12 months.
Yeah.
And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in
not a good
weaker
data
than
point.
expected.
Remember, what
But
he talked
at the same
about
time, I
earlier
would say
is
that's
that
probably the
these
best
2 basis
estimate
point
of where the
raises
committee's
of
thinking is
0.75
still, which is
are
that
still
we would get to a
behind what will
moderately
affect the
restrictive level
market.
by
So
the
we
end
could
of this
see a
year,
lot
by
more
which I mean somewhere
CPI
between 3
pressure
and 3.5%.
post these 2
and that the committee sees further rate
interest rate
increases
raises.
in 2023. As I mentioned, we'll
big one.
update that, of course, at the September meeting. But that's really the best I can do on that.
And really, this
said
is
inflation
definitely
had been
not
little
a
bit hotter,
dovish
than
position
anticipated.
overall,
Has
what
your
he's
view of
talking
the
about.
terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading.
So I
but
think
this
we'll
one,
most
this one
likely see a
was
little bit
even
of
worse than
correction on
expected, I
Bitcoin
would
tonight.
say.
It'll be interesting to see
I
the
don't
sentiment
talk about my
coming
own
in today
personal
on
estimate
retail traders.
of what the terminal rate would be. I will write down that in. It's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting.
This will be good.
Based on
This
the
will be
data.
good to see it, because this period of time is going to be very critical, because he's right. So much
Hi,
could roll
Gina.
up on here.
Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman,
Yeah, I
CNBC.
think
Thanks for taking my question, Mr. Chairman.
He knows
Earlier
it's
this
coming.
week, the president said we are not going to be in a
This is a good
recession.
one.
So I have 2 questions off of that. Do you share the president's confidence in not being in a recession?
Finally, somebody
And
asked
second,
the question.
how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very
Would agree,
high growth
definitely.
of the
Has a little bit of a
reopening
nervous
year of
position, and I do think it's still a kind of a scenario where he knows what's
You're
coming.
also seeing tighter monetary policy, and you should see
Just
some
in the
slowing.
lagging
We
side
actually
of
think we
things
need a
of
period
these 2
of
basis point
growth
raises.
below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions.
Yeah.
And those are
That's the
things
big
that
one.
we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
Which I don't see it ever going back there. I think we are in an inflationary period of time. It's just one of those things.
So we're going to be focused on getting inflation back down. And
He's dodging the question.
as I've said on other occasions, price stability is really the bedrock of the economy. And nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must
I think
do.
Bitcoin is
And we
still
think that,
undecided
we don't
on
see it
whether
as
or not
a
this is
trade-off
hawkish or dovish.
with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters.
Might
particularly
happen,
in regard to
Brad. We could
expectations,
see that 24.
it's
Remember,
been said
we
the last
did a-
few months that the risks of
Let me
doing
hear
too
this
little outweighed the risks of doing too much. Does that remain the bias?
Okay.
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong
So
labor
they're
market. As I
clearly
mentioned,
denying recession
along with,
at this
in all
point.
likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further.
Ooh, interesting statement.
You know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Yeah, this is going to be interesting because he is right. He's on tightrope.
Neil Irwin from Axios.
Being able to deal with this, I
build
think,
a little bit on
this,
what Steve was asking.
What I feel is still a little bit of a softer side.
Do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
Those numbers are already.
So, I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market.
I'd love to hear what those pieces are.
As I mentioned, it's true that growth is slowing.
High performers.
And for reasons that we understand, really the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
Right now.
Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports.
Funny numbers coming in on GDP
with a grain of salt. But of course, it's something we'll be looking at.
Even though that's been kind of the cornerstone of really understanding
Victoria
what
Guido,
the
Politico.
economic position
I wanted
of
to
the US
ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared.
Insider trading.
And the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just I think we've really created a very strong and robust set of rules that will.
They don't seem to be
support
getting
public trust in the
into, other than a
institution.
couple of
And,
questions
again,
directed at him on
we're
the
just now,
true
the system is just
status
now
of
up
whether or
and
not
running,
we're in a
and
recession.
I'm proud of what we did.
They seem to be letting him off the hook a little bit as to whether or not, what is the path forward? How do we deal with the next,
Katarina
and how do we get
Saraiva,
to 200
Bloomberg
basis
News.
points before the end of the year?
I wanted to ask a little bit more about the 75 basis points versus 50
we'll get it here.
versus 25. Can you talk a little bit about what kind of goes into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be.
Nothing there.
But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Well, I think the jobs numbers, to answer your question that was just up on screen,
thank you.
is jobs
Chris
numbers
Rugaber,
will have to
Associated
show
Press.
up. We'll have to see some real correction in the
about,
housing industry. Those will be
right
some
now
additional
there's a
fortifications
growing
of
gap
that
between
position.
the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE
normal
index
stuff
does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
Yeah, there's some good questions coming in also we'll try to get to some of those before
I'd like to
we
weave
wrap up.
a couple of things together, Mr. Chairman. Michael McKee
We'll
from
probably get a
Bloomberg
couple
TV
more
and radio.
questions here during the
You said that the
press
destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well,
Yeah.
just
That's a
talking
good
about
question.
demand for a second. As I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor
There's some
market
really
is
good
strong,
points that
and
he's
the economy
making
has gone
throughout
right through
these
that and been
responses
fine.
that I think
So
need to
that's
be
happened
compiled
many times
and
it
looked at.
used to
I'll
happen, if you
comment on
remember,
a
in the
few of
first
them at
quarter
the
of
end,
every
but
year for several years in a
there's
row,
some very
GDP was
significant
negative,
points he's making
and
here.
the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a
Make sure and
great
put some
deal of
questions
money
in over on the
people's balance
sidebar. I'd love to
sheets
get you
that they can
guys'
spend.
feedback on what
The
you
unemployment
think
rate is very low.
Chair
The labor
Powell is
market's
doing. Is
very
he
high.
hawkish
There are
or
many
dovish
job openings.
on the way you're
Wages are
reading
high.
this
So
right now?
It's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing.
Traders are in
second
the
quarter.
house working
That
the
is
charts
fairly
today.
broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running
Just
below
a
potential
quick answer there,
for a
Tarek. I
sustained
would.
period to create
It's
slack
just
and-
this is just a
and
thing I
keep
do all the
inflation
time.
at
Get
some
everything on to hardware wallets. That's my move is self custody.
Hi, thank you, Chairman. Nicole Goodkind, CNN Business.
I don't trust any exchanges.
When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
Kind of a reiteration of a
think
job
you're
he already
already seeing,
or
you've
an
seen
answer
in the labor market
he already
what you've
gave.
seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for insurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they
I would
appear to be
say
moderating.
he is
Not so
pulling
yet
on
from
the
other
neutral
wage measures, and we'll be getting the employment
position,
compensation index
but
measurement, I think, on Friday. Again.
I still
And that's
feel
a very
that
important one because
within
it
all of
adjusts for
these questions, he's made some very
composition.
significant
So
statements
I'd say
that
and
lead
also
you in to
anecdotally,
believe
you
otherwise. I
hear
still believe this is a
much,
bit more hawkish
the sort of
than dovish.
level of
and I'll explain why.
concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So
Yeah,
there's
David,
a feeling
I'm
that the
leaning a
labor
little bit
market
more
is
on the hawkish
moving
side, and
back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has
big time.
no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence.
There's
that's
a
the case.
there's
So
a
we're
reason
not
for
seeing
that
much in
as
the way of
well.
labor
I'll
supply.
point that out of
Nonetheless,
why we haven't seen
I would say
increase in
some
labor
some
supply
progress
versus
on
labor demand.
Demand and supply getting back in alignment.
Yeah, a lot of key points here that he's made throughout
we're
the
gonna be looking
responses. I'm surprised he's given this many
At
answers, though.
inflation as well. As I mentioned, we need to see inflation.
He's normally
coming
pretty
down.
tight on
We
these,
need to
and
be
we're actually
confident
rolling
that
up on the
inflation
hour
is going to get back
over
down to
304.
consistent levels.
He normally tries
That's
to
not
lock
something
these
we
down,
can
so that's a good
avoid
sign.
doing.
That's a good
That really
sign.
needs to happen. But we do think, though, that the labor market can adjust.
Of course, you could take it two ways. Is that
because
he's
of the
trying to
huge
get
overhang
calm
of
in the
job
market,
openings,
so he's
of excess demand,
giving
really.
more
There
information.
should be able to be an adjustment that would have lower than, perhaps
Abrupt
lower than
meetings are always,
expected
you know, like, hey, we're
increases in unemployment,
reining
lower
in
than
the
would be
information,
expected
and
in the ordinary course of events,
those are
because
usually due to
the
some
level, the
significant
ratio
issues.
of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman.
Yeah, several
Edward Lawrence
points.
from
Several
Fox
points we
Business.
gotta cover,
So you said the path
for sure.
may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now, and I think you do see weakening.
Doesn't seem.
Some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So
They're just
overall,
leaning so
you would
much
say
on the
that
labor market here. I just feel
in all
like this is going to turn
probability,
around
demand is still
and bite
strong,
them in the butt.
and the economy is still on track to continue to grow this year.
This is,
But
yeah, I think it's just a scenario where you've
the
got
slowdown in the second
you've
quarter
got too
is
many
notable, and we're going to be
too many pressures coming into the market.
Sorry, what was the lot?
You know, how did bank forecasts of possible recessions, economists, does that affect the soft landing?
Well, you know, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal,
Yeah.
and we'll keep trying to achieve it. I do
A
think
lot of
events,
points here we need to make on
at
what
the
Chair
beginning, we
Powell
said
is
it was
talking about.
not
because
going
this
to be
is,
easy. It was going to be quite challenging to do
there's
that.
some key things he
It's
mentioned in
unusual.
here. We definitely want to get
It's
to
an
those.
unusual event. It's not a typical.
I know we have a poll coming
given
in
where we
as
are.
well.
If there is a path to
Quick
it, and
one
we
right
think
here,
there is,
24
it
hours
is the
after
one
Fed
that
meeting and earnings,
the labor
crypto
market
market will crash, will rally.
such a large amount of surplus.
We have a mixed audience right there. This is good. This is exactly what we're expecting from the Fed report, which is what we're hearing right now.
A big increase in unemployment, as you would expect.
This will take a
in the
lot
ordinary
of
course, because,
analysis to
frankly,
really break down his
the imbalance is so much greater.
his intent.
But we
here,
don't know.
'cause there's a
I mean,
lot
this
here.
is a-
Remember,
this is a
8
case of
weeks
first
before we see
impression.
another meeting.
So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly
Interesting.
say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Lots happening, and he's continuing
Thank
to
you,
take
Mr.
questions,
Chairman.
which is
Jean Young with Market News.
a little unusual.
I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it.
Quantitative
What are you
tightening.
learning about how it's
That's what
working
she's talking
and how
about.
markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case.
We should
So,
probably look
I
at
would say the
take a look
plan
at
is
the 10-year Treasury.
broadly on track. It's a little bit slow to get going
Treasury
because some
chart
of these
as well.
trades don't settle until
If we can get to it.
for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Yes, mortgage rates will increase. Mortgages are going up for sure, and that, again, this is more pressure on the housing market,
Finance.
which is one of the
Looking at
lagging
financial conditions.
sectors.
It seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways. When we talk about a hot housing market, still, just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations. Break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%.
The inflation
so
number
we'd like to see
on the
market-based,
next print
readings
will be
of
critical
inflation expectations come down.
on how we start to see the
broader
Fed react
financial
in
conditions
the
have
next
tightened a
meeting,
good bit.
for sure.
I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation
Bitcoin
will be
closing
moving
in
back
on
down to 2%.
23,000 right now. Looks like
So
at
that's how we're gonna take it. And
22,745.
of course, we'll be watching financial conditions
So
to see
interesting,
that they are
interesting
appropriately
stair
tight
step upwards
and that they're
as we
having the
look
effect
into
that we would
a
hope
nice
they're
little.
having,
Hopefully, some of you
which
guys were
is to
longing in
see
this
demand
position
moderate
today
and inflationary
and did
pressures
pretty well,
recede
or
and
did a
ultimately
spot
inflation
trade
come
and
down.
are doing a nice little swing trade here. This could be the point that Gareth and I were talking about earlier this week on his live stream on Monday with us, where he felt like we'd see a 25, possibly a 28.
A little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would
Make
say
sure you smash the like button if you guys
One,
like
I
these
don't
kind of
think
live streams. It is
that
important
materially
for us to
changed the
understand if these are
situation. But
helpful
I have
for
to
you
admit,
when we're
I don't
breaking
think I
down
would
some of
do
these
that again.
things, running
I don't
charts.
think I would do that again.
Giving you guys some news
ultimately,
stories that kind of compare to what Chair Powell is talking about. And then also, we'll wrap up here shortly with just my opinions on, and also some very important notes I think he made in this statement today, because there's some very key answers that he gave today for what's happening right now, and really what their expectations are going to be. Let's cut back to it before he wraps up.
3 months earlier.
Maybe one more question.
It didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Bitcoin hitting 22.8.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been.
I think these are some good questions
right?
here,
So there
guys.
was the famous
will
one
the
in
market
2013.
correct down
There's
quickly
what
after
happened
this
at the
bump
December
today? We're going to
18
answer
meeting
that
where,
after the show, or
markets
after
can
Chair Powell
ignore
gets going. I'll get to
developments on the
that.
balance
We've got a
sheet for
lot
years
of
on end,
lineup
and then
here in terms
suddenly
of just some good questions. I
react
think that
very sharply.
many of you are going to want to know.
We just had to
Dollar
crack
conditions, economic forecasts on CPI, how this plays out into the market over the next few weeks.
We were
got a little
careful
bit of a
to-
runtime here, for
to
sure.
take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy. 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening.
A lot of
economy.
time
That
today,
was
too, to
where
the
the big
reporters.
uncertainty was, and our view was that the supply side issues would get better. That that people would go back to work. That labor force participation would come back. Everyone would get vaccinated. Schools would open. Kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. The supply side issues would get solved reasonably quickly, and they just haven't. They still haven't.
Yeah.
So that's
yeah,
really
I
the
would agree.
learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And
Bitcoin's
so
struggling right there at
that's
22.8.
really
This is
what
interesting because
accounts
this
for
is
the pace at
a
which
if
we
you
moved.
if
And,
you
we
zoom out
did-
on that, guys.
when inflation
and take a look at one of the resistance levels on 22.8. We'll squeeze out on that. I'm just kind of curious where, because we've crashed through on the, where it has been on the week for sure overall. And I think that'll be the question mark on how the charts really kind of play out, because this is going to be, I think, a chart extravaganza on what the market is going to look like. I think you're in the 1 minute, so you're going to be difficult to get to all that. But one thing for sure, I know he's wrapping up here. One more question, it looks like, coming in from
GDP number tomorrow for the second quarter. Would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the
Again,
Fed?
I don't think he's going to say
So
the word.
The Fed doesn't make a judgment on that. You know, we're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing.
That's
so
yellow.
that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, you know, if you think about what a recession really is, it's a broad-based decline across many industries that you know, that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't. This doesn't seem like that now. What we have right now,
we're
doesn't
right
seem
at
like that.
the. If you go to the
real reason is
4-hour
that
chart,
the labor market
if you
is
guys
just
want to cut to my
sending
screen,
such a
the
strong
4-hour chart,
signal of economic
we're right at a
strength
resistance level right
that it makes
now,
you really
which is
question
that
the GDP.
22.8.
But again, that's not a
ish, hovering right now at 22.8. That'll be the question mark. If we continue to blast through there is the 23.6, which was one of the big points that we saw just about a week ago on good performance for crypto, especially around Bitcoin as well. And I think softening in the labor market, they're getting back into it. I'll cut away from this. Some of the key things here that he's hitting on is the labor market consideration, that they believe the labor market is still somewhat strong. Remember that we had a massive amount of print of US dollars to adjust for what's happening, you know, around the pandemic. And obviously that caused an absolute crush on the overall supply demand issue, primarily the demand issue for labor and the supply. What he was surprised with, though, if you'll remember what he said, he's surprised that the supply side of labor has not necessarily increased, meaning that people are still staying home, possibly still causing potential strain on the economy, but at the same time, we're starting to see softening within the job market itself. So this will be a very interesting 8 weeks between now and the next Fed hearing that will play out two ways. One, if you're going to continue to see CPI roll up, and I think the question will be if we get a positive print, meaning over 9.1 in our next scenario, then we've got a continuous run on the pressure that he even mentioned, Chair Powell mentioned, that a lot of this is lagging. These two 75 basis point raises, he believes, have not taken the market effect just yet. Now, what does that mean for Bitcoin? Does this mean that Bitcoin and crypto in general will probably see a little bit of movement here, and then possibly a fairly strong connection? And if you look at just this green chart, just right here on the 4-hour, you can kind of see the kind of movement that we're in right now. This is, if you guys were trading it, was a nice little move. The question of whether or not this holds is really questioning on the basis of sentiment. This is something we'll be measuring on the CPI this afternoon. We'll try to lock those in before we wrap up on data for what and how the Fed responded to this. So there's going to be a lot, I think, that will paint out over the next few days. The question is, can we break through the 22.8, getting in really to its next real resistance level, which is the 23.6 mark for sure. So I think this will be interesting to see if we can make it through that, through the night. Again, I'm feeling that this is still a little bit hawkish in the sense that he has clearly explained two things. Housing market most likely going to get hit. Labor numbers still softening. Most likely the demand and supply scenario is going to play out. And then number three is really kind of the issue of the trailing impact of the economy based on the 275 basis points moves that he's talked about and moved on. So I think this is going to be something pretty heavy. I want to cut back to Chair Powell because I think he's talking about a section here on
all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well.
Just,
you know, going forward,
the same thing. Got a good script.
What we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the
no
labor
new
market,
good
but it will only be
questions
the
here, guys. So
beginnings.
we'll wrap it up
So,
and try to get to some of your
and I
questions
mentioned
that you
I
guys
also
have
said-
here on the show today, and run into a few of these. And remember, smash the like button. We love to get your feedback. Do you like these kinds of live streams? We do these on the channels occasionally. There are other types of updates around what's happening in the market. Obviously, this one is a big one with what Chair Powell is doing and where the Fed, because it is so tied to what's happening in Bitcoin. Now, my assessment is pretty straightforward. I still believe this is a hawkish statement. I'm not looking this as dovish just because of the indicator that we've had 275s in a row. He clearly hasn't indicated that he's going to be pulling off the gas just yet. He is very bent on reaching the scenario of reduction in the overall inflation. And I think that is going to play into a much stronger position going into those 200 basis points that we needed before the year end. So he's definitely going to achieve that. And the other factor is quantitative tightening. So if we continue to see a reduction in the balance sheet, this is going to put some pressure on the crypto markets because this will strengthen the dollar. Obviously, when you start getting fiscal around your balance sheet, the dollar strengthening is very positive. When the dollar is strong, crypto is a little bit soft. So remember that. The dollar is a safe haven for massive investors who are sitting on the sidelines waiting for an entry point, just like you guys right now. You can be little doing your swing trades, and you could be doing things of that nature, possibly longing Bitcoin in this particular case, maybe you shorted it, all those kind of scenarios. All of that plays into this, but in the long term, to answer your question, Armez, is that I'm still a little bit bearish on where Bitcoin is going to be going. I think we get a little run here, and this is something that we've talked about here on this show many times on this show, and that is that we could see a little run, whether it's 25 or we do get a 28 run, but we will see a correction in the market again because of the lagging numbers. That 1.5 points that we've received in the last 60, 75 days is heavy. It has slowed the market. We will see job numbers starting to slow again, and I think the big question, and they'll be talking about this in the fall, is the credit position for sure. Let's go over to a couple of questions. John Breen, will Bitcoin reach 100K in August? Ain't no way. Ain't no way. Are you bullish or bearish? I'm definitely still a little bit bearish on the basis of what I heard today. He did not give me any indication that he's pulling the gas off at all. A 75 print, he's expecting more pressure from the CPI, and he's looking at a softening of both consumer spending and also a softening of potential job positions. And don't forget the housing market that's coming in, barreling in behind us because of the slowing mortgage rates. So that is why I'm still a bit bearish. And if you follow my thesis often, you guys know I'm still a conservative investor. I'm very cautious in moving. I'm always looking at, sure, I do some degen moves in metaverse and gaming, and I love those. But for the most part, I'm looking at how this plays out through the midterms and into Q4, which is a very important time, not only for what's happening here, but also happening in the S&P 500, which will be very critical in Q4. A lot of big earnings numbers will be coming on. All right, so hey, Paul, how would these numbers affect my entry points for the 20K portfolio? Some of these are still going to be, I think some of our entry points, if you guys didn't watch our 20K portfolio series, we have 8 videos breaking down a whole bunch of tokens that we're going to be looking at. I think there's going to be some buys after this. This week, I think we're going to see some entry points. I'll tweet those. We'll drop them in the Diamond Circle. Maybe on some of the live streams here this week, we'll drop in some trades as well of what we're doing in that inventory and get into it for sure. Do you think the market will correct down quickly after this bump today? I think we'll see a little bit of sideways action. I'm going to wait and see the CPI, our crypto power index ratings, because that will tell me a lot more on which direction we're going to see Bitcoin go. And of course, obviously, that has a lot of information in terms of Ethereum. Where is Ethereum? By the way, did we pull the Ethereum chart? Let me just jump to that quickly. Where is it? It's still running at, yeah, it's getting ready to break 16, so not bad. Let's get to another question. So will the crypto market go sideways at next 8 weeks on this meeting? Will be interesting to see all the effects. I think you're right, EMOJ. The scenario here, again, I'm feeling a little bit more sideways action. Whether or not we get to that 28, if we do get a high at that 28, which is Gareth's number, then that would be impressive. That would be impressive. And the question would be where that retracement comes from. And do we get a chance to get back in at that 20K level? Because as you guys know, that's my buy position for Bitcoin. That's when I start dollar cost averaging and looking for opportunities and major events. Do not forget, we have a big scenario occurring right now in the industry with what's happening over at Coinbase. So the SEC is on a hunt, and that could also have some bearing. Obviously saw our video before. If you watched it, check out the video on Coinbase, because obviously we had a huge stock vacated by Cathie Wood. What are your thoughts on strategy for the month? I'm still a very soft position, but I am looking for very specific buys. So anything that is starting to show red after today, then I'm going to really consider, if they're in my top 20 targets that we built in that portfolio, I'm going to start looking at those. And then also in my own holdings of some of the things I do there. Do we take profits before tomorrow info comes out? I would say yes. If you made it up to this, depends on where you are. I mean, because everybody, for me, if I was in a trade right now, pre-FOMC, I would probably take that $1,000, because it looks like we're getting about a $1,000 move here. And could we go to 20, deep into the 23s? Very possible. And if we do, remember, we've got overnight trading with Asia right now, which they're watching a lot of what's happening right now. So that'll be very interesting. What about GDP impact tomorrow? He's trying to downplay that. We talked about this a little bit earlier. You're going to see Yellen's press conference tomorrow talking about these GDP numbers. That might be something we want to talk about. We will do a report on it for sure. But the point is she is going to downplay it, along with, I think, a lot of DC in general is downplaying the GDP numbers, which will come in technically and historically that would indicate 2 down quarters equals recession. Again, they're trying to reposition this whole scenario. So right there, we've got Bitcoin now over 23K. So as I said, if you're on this short trade and you've had a chance to make one, this might be a nice little spot to be looking for. Start setting your stops and ride this one up. You never know where it could stop. This could go all the way to 25. It'll be very interesting. Sentiment data we'll have out shortly, and we'll try to get to that, you guys. So hopefully we're going to churn up all that stuff, get you guys going. Don't forget to sign into or join into the Diamond Circle. If you're already there, get in onto the Diamond Circle. It's the best thing. It's free, and it's absolutely the way to kind of jump into our community. If you want to reach me, it is out on Twitter at Paul Barron. We'll catch you next time right here on Tech Bath.